Hey everyone, and welcome. If you're currently grinding away for your C11 exam, you are in the perfect spot. Today we're going to lay the foundation for, well, pretty much everything in insurance by answering one huge question. What exactly is risk? Let's get into it.
You know those days, right? Where you just wake up and everything feels off? You spill your coffee, you can't find your keys, and you just have this feeling that something's waiting around the corner. So you're in your car, you're backing out of a tight parking spot, you're being so careful, checking all your mirrors, and then you hear it. That horrible, stomach-dropping sound of crunching metal. Ah. That feeling, right there in the pit of your stomach, that is the exact moment we're talking about today. It's when the possibility of something bad happening suddenly becomes a very real, and usually a very expensive problem. And this brings us right to our official definition.
Okay, get your highlighters out, because for the C11 exam, this is the definition you need to know, word for word. In the world of insurance, risk isn't just some vague concept. It is very, very specific. It's the chance of a financial loss. Remember that. When we talk insurance, it always comes down to the money.
Now, not all risks are the same. And this next part, this distinction, is absolutely critical for your exam. I mean, it is almost guaranteed to be on there, so let's make sure we nail this down.
Just look at this diagram. Think of it like a fork in the road. Every single risk in the universe has to go down one of these two paths. It's either a pure risk or it's a speculative risk. There's no in between.
So first up is speculative risk. This is basically any kind of gamble, like buying a stock, betting on a sports game, or starting a business. You can make a ton of money, or you could lose everything. And because there's that chance to win, to gain something, it's called speculative. Here's the key takeaway. Speculative risks are generally not insurable. Why? Well, how can an insurance company predict a loss when you might actually win? They can't. And on the other side of that fork, we have pure risk. And this is the entire world of insurance. Think about owning your car. Just by having it parked in your driveway, you're not gaining any money. But there is a downside, right? It could get stolen, it could get in an accident. That is pure risk, just the chance of a loss, with zero, and I mean zero, chance of a financial gain. Okay, this slide right here, this is your study guide gold. Seriously, take a screenshot. It all comes down to two simple questions. First, is there a chance to gain? For pure risk, that's a hard no. For speculative, it's a yes. Second question, is it insurable? For pure risk, it's usually. For speculative, it's a big no. If you can remember this little chart, you've got this concept locked down. All right, so since we know insurance only deals with pure risk, let's zoom in on that side of the map. The C11 exam takes all those insurable pure risks and sorts them into three neat little buckets that you absolutely must know. And here they are. It really is this simple: personal, property, and liability. Pretty much every general insurance policy you'll ever encounter is designed to cover a risk that falls into one of these three categories. Let's quickly look at each one. First up, personal risk. This is all about you as a person, your health, your body, and your ability to earn an income. The financial loss that comes from a major illness or an accident that keeps you from working, that's personal risk.
Next is property risk. This one's pretty straightforward, right? It's the risk that something could happen to your stuff. Your house, your car, your phone, your laptop. If you own it and it can be damaged or destroyed, it falls under property risk. And finally, we have liability risk. Now, this one is a little different. It's not about damage to your stuff. It's about your legal responsibility for causing harm to someone else or to their stuff. So, if someone slips on your icy sidewalk and decides to sue you, that's a liability risk. It's the threat of being held financially responsible. Okay, we've covered a lot of ground. You've got the definitions, you know the categories. Now it's time to put it to the test with a quick quiz, C11 style. You ready? Question 1. Buying a stock that might go up or down in value is an example of what kind of risk? Is it A, pure risk, B, personal risk, C, speculative risk, or D, liability risk? Think about it. Is there a chance for gain? Question 2. Which of the following is a key characteristic of a pure risk? A, it always results in a gain. B, it involves no chance of financial gain. C, it is always uninsurable. Or D, it only applies to property. Go ahead and lock in your answer. All right, question number 3. A house fire that destroys your home. What category of insurable risk does that fall under?
Is it A, property risk, B, speculative risk, C, personal risk, or D, market risk?
And last one, if you are found legally responsible for injuring someone in a car crash, you are exposed to what kind of risk? A, personal risk, B, property risk, C, investment risk, or D, liability risk. Okay, let's see how you did. For number 1, the answer is C, speculative risk, because a stock can go up or down. For number 2, it's B, no chance of financial gain. That's the textbook definition of pure risk. For number 3, the answer is A, property risk, because your house is physical property. And finally, number 4 is D, liability risk, because it's all about your legal obligation to someone else.